Welcome in, and thank you for joining us for another episode of Healthy, Wealthy, and Wise Retirement. Your host, Lauren Sherman, is a certified financial planner and owner of the flat fee firm Integrity Wealth Management. He curates each episode with you in mind. Whether a work-optional lifestyle is on the horizon or you're already there, this show has something for you. With that, listen in, and I hope you enjoy the show.
All right. Well, welcome in to another Healthy, Wealthy, and Wise Retirement. I am, of course, your host, Lauren Sherman. And today I have Steve Blackwell joining us, the CEO of Invito Energy Partners. Before I jump into anything else, Steve, just thanks for making time and sharing your expertise with us today.
Well, Lauren, I'm happy to be here. Thanks for the invitation. I'm looking forward to having a good conversation that's hopefully beneficial to some of your listeners.
Yeah, and there's a lot that we can dig into in the oil and gas space, but it can get a little bit of a technical conversation. So I'm going to kind of try to segregate the conversations a little bit from the investment aspect and then to the tax aspect so that we're really keeping those separate. But before getting into all of kind of the nuts and bolts of it, why don't you share just a little bit about yourself, your background, maybe the team around you, so that everybody knows who we're talking with here.
Sure. Yeah, that's great. Well, again, Steve Blackwell, the CEO and co-founder, along with my partner, Christianson of Invito Energy Partners. So my background in energy is I've been in this space a little over 17 years. I'm a finance and accounting guy. I'm originally from the Midwest. Went to school at Central Michigan University. I have a degree in finance and accounting. Spent my first 16 or 17 years in the mortgage banking world, the last 17, 18 in energy. I was the president of an upstream oil and gas company called Petromax. I was the COO of another company called U.S. Energy. And now I started, along with my partner, who's a petroleum engineer, Invito Energy Partners. And my partner, Jared, is a petroleum engineer, University of Tulsa, been in the oil industry right out of college. Worked in the oil fields, been on the engineering side of the business his entire career on the production side. So, we have a lot of experience in oil and gas. When I was the president of Petromax, we sold 5 assets for about $1.3 billion. We were doing much larger institutional-like projects when I was there. We've drilled wells in pretty much every basin in the lower 48. So a lot of experience on the upstream E&P side.
Yeah, no, appreciate that. I can tell you've had to give your background a time or two. You got it pretty well pinned down right there.
Yeah, a few times.
So let's start on the investment side, because for me, as a financial advisor, that's where it has to start. Like sometimes I think we kind of, the old saying, you let the tax tail wag the dog. So really starting from the investment aspect, can you just, I guess, high level that for us, and
Sure.
then maybe I'll ask some specific questions as we go.
Yeah. So let's do a little macro view to help people who may not be familiar with energy at all.
Yeah.
In the energy sector, there's really 3 categories. There's the upstream sector, the midstream, and the downstream. Upstream are the companies that drill wells, oil and gas wells. Midstream are the pipeline companies that are moving the hydrocarbons around the country. And downstream are like the refineries on the coast that are taking the raw product and turning it into whether it's gasoline, diesel fuel, jet fuel, et cetera. So an investor can invest in any one of those sectors if they believe in the energy sector as a whole or a specific sector. They could go buy a publicly traded company, they could go buy an ETF, a mutual fund, et cetera, right? Mm-hmm. So that's kind of an overview of the upstream or the oil and gas industry. When people are investing directly into the direct assets, the most common way is in the upstream side. And the reason for that is that the CapEx for midstream projects or downstream projects are really large, right? And so getting directly into the assets is most common for retail clients in the upstream. In other words, investing directly into oil and gas wells. And so when you do that, you are really buying 2 types of assets. You are buying what's called working interest or royalty interest. And you can buy either one of those in a well that is already producing. So meaning you're just buying into a stream of cash flow,
Right.
like any other cash flowing asset, or you can buy in working interest or royalty interest in wells that have not been drilled yet. Okay. And so the difference between a working interest and a royalty interest, working interest is like equity. If you own working interest in a well, and let's say that you own 10% working interest in a well, and that well costs $10 million, well, then you're responsible for $1 million of the CapEx. Then you would pay 10% of the monthly operating expenses, and then you receive 10% of the net revenue.
Sure.
Royalty owners or royalty interest, there's a royalty rate on every well. And that royalty rate will range from maybe as low as 12.5 to maybe as high as 30%. And so if you're an owner of royalty interest, the benefit there is you don't pay the CapEx, so you don't share in the cost to drill the well. You don't pay any portion of the operating expenses, and you just get paid. You get paid first when there's revenue. And so the easiest example I can give is if there is a well that has $1 million of revenue, and let's say that the royalty rate was 20%, just to make the math easy. 200 grand would come off the top and go to the royalty owners, and that 800 grand would pay the operating expenses, and then whatever the net revenue is, that would get distributed to the working interest owners. Okay. So that's kind of a high level understanding of oil and gas sector and how you can invest directly into the upstream side. Does that make sense? Or
yeah, I think that's helpful. I think also just talking, and this will maybe hit home for people that have been in this kind of realm with the private equity a little bit more so than those who haven't. But maybe talking through, I think one of the things unique about Invito is that you guys work with financial advisors, and I've heard you say that the first goal anytime you're talking with an advisor is, they say, don't lose my client's money.
right.
And maybe sometimes people have either prior experience or have had good or bad experience with oil and gas in the past. I think it's maybe a little bit helpful what you guys referred to as like the tier 1, 2, and 3 locations. Would this be a good time to talk through that a little bit to kind of level set what we're looking at kind of from a risk perspective too?
Yeah. So, I mean, depending on who you meet, the advisor or the individual, right? Some people have some preconceived notions of oil and gas or some past experience or know somebody that invested in oil and gas. Yeah. It's not uncommon to have someone that's invested in oil and gas, and their experience is that they didn't make any money, or they got a good tax deduction, which we'll get into in a minute, but then they didn't, make any money. So, but look, at the end of the day, oil and gas is inherently a high risk, high reward business, right? I mean, that's the nature of this beast if you get into it. And that's why there's a lot of, uber wealthy companies and uber wealthy individuals who took a lot of risk and were rewarded handsomely for that risk. When you're investing retail capital through wealth managers, right? That's where the number one mandate typically is, hey, don't lose my client's money. 1A, don't lose my client's money. 1B, make my client money. But before 1B, don't lose my client's money.
Right.
And so if that's your mandate as an asset manager of a fund, you're really limited in what you can invest into. So a lot of the projects, or what we would call drilling locations, that are normal for an oil and gas company to invest into and to allocate capital to, you cannot do that. You cannot invest into those projects or those prospects when your mandate is to not lose capital. Right. So the easiest explanation of that is tier 1, 2, and 3. And so really the differentiator between the three of them is really the amount of data that's available. So there's a discipline in our industry called the reservoir engineer. So there's a lot of different engineering.
Say that again, the reservoir.
Yeah, so in oil and gas, there's a lot of different engineering disciplines. Well, there's a production engineer, a completions engineer, a drilling engineer, and then there's another one called a reservoir engineer, right? A reservoir engineer's job is to create a data set and go in and dump that data into a oil and gas software and determine, okay, what is this well going to cost? What is this well going to cost to produce? And then more importantly, what does the production profile look like? So what does the initial production look like? And what does a decline look like over time? And how much ultimately will that well produce in either oil and gas or the combination of both, right? And so when that engineer is going into what I would call a tier 2 and a tier 3 location, they're going 5, 10, 15, 20, 25 miles away to gather that data, to create that data set. to determine those three things I talked about: what it's going to cost, what it's going to cost to produce, and what's the ultimate production look like. Well, when you're going that far away for data,
Yeah.
think about it. When we're subsurface, we're talking about drilling, 6, 7, 8, 9, 10,000 feet below the surface of the earth, and you're going that far away to gather data. The range of returns on those prospects could be a dry hole, an uneconomical well. An uneconomical well is a well that produces, but it doesn't cover its own expenses. A well that produces and pays out, but it doesn't reach payback. Or it could be a fantastic well. It could be a 3, 4, 5x well, right? And it could be anywhere in between. So if your mandate, right, is don't lose money, and that's the range of returns on tier 2 and tier 3, can you invest in tier 2 and tier 3?
Yeah, you wouldn't be able to, right?
Well, and not if you truly want to manage the downside risk, right?
Right.
Because all it takes is to get into, one well that doesn't produce or is uneconomical is going to kill the performance of a fund and potentially limit your ability to even return capital, which is
Right.
not protecting principal. So for us, what we do is we focus on what's called tier 1 locations. And again, the difference is when that engineer goes in to create that data set, typically they're going to look in about a 3-mile radius around where you're potentially investing. And in this case, there will be a significant number of wells already drilled within that 3 miles. So that when that engineer gets that data set, there's a lot of wells that are close by with seasoned production. And now when he comes out with those predictions, he or she predicts what it's going to produce, what it's going to cost, what it's going to cost to operate, the statistical variance on what their prediction is should not be significant.
Yeah.
So
Yeah.
when you're in tier 1, you shouldn't be getting into wells that are certainly not dry holes or even uneconomical wells. And for all intents and purposes, you really shouldn't even be getting into wells that don't reach payout. And so from our standpoint, when we opened Invito and we thought about the clients that we were going to call on, in other words, wealth managers primarily, who are bringing their clients into our fund, and with that mandate as an asset manager, that's why we developed a strategy of we're going to have to go focus on tier 1 acreage. And so that's what we do. And
Yeah, that makes sense.
yeah.
Yeah, and we have a lot of clients at our firm that are a little bit more technical thinking. So I think they kind of grasp the concept of like standard deviation or a bell curve,
Yeah.
where
Right.
a bell curve, with wide variance, where we have a wide range of outcomes on the edges. To me, that's kind of more what you're explaining in like a tier 3 or maybe even a tier 2. And tier 1, we're really trying to tighten up that range of outcomes where
Yeah,
at the end of the day, there's still a risk involved because it is an investment, but
sure.
we're trying to tighten up that range of outcomes essentially.
Yeah, we're trying to limit the downside. You can never guarantee the upside in any type of investment. And tier 1 acreage costs a little bit more, so you give up a little bit because it costs more to get into.
Yeah.
But again, if your mandate is don't lose money, right, which it's normal for an oil and gas company. All oil and gas companies are allocating tier 3 and tier 2 and tier 1 as part of their CapEx. Think about tier 3 and 2 as like R&D money, right? If you're not constantly looking for new areas and pushing the boundaries of plays to create new areas, you'll eventually run out of tier 1 locations, which is where you drive the majority of your cash flow. So that's a normal course of business for oil and gas companies, exploration companies. We're just focused on the tier 1. And more specifically, today, most of that acreage is owned by the bigger E&P companies. So more specifically, what our fund does is we go in and we acquire what's called non-operated working interest. In other words, we're acquiring working interest. We're not the operator. Another company's the operator. Because most of the tier 1 acreage is owned, we go in and we acquire small fractional working interest. So it could be 1%, 0.5%, 2, 5, 10% in wells being drilled by the larger E&P companies.
Which are going to be your name brand, some of those big
Yeah, some of them you'll all
from.
recognize, some of them you wouldn't recognize.
Sure.
The average person's not going to recognize all of those companies, right?
Yeah.
But the bigger publicly traded companies they would recognize, and or the large independents or a private equity backed firm. You want to make sure that the company that's operating it is a well capitalized with a strong balance sheet company and it has a full technical team underneath their organization. So yeah, that's what we do. And so the cool part is if you think about it, you could put in $100,000 into our fund, and part of your money is going into a well that's being drilled by EOG, one of the largest publicly traded oil and gas companies in the United States. That well could be $10 to $15 million by itself. So here's EOG, a large publicly traded company, who's putting $10 to $14 million or in that range into one well, and they've already
Right.
spent hundreds of millions of dollars in that area to de-risk it, and your money is going into the same well. Your
Right.
50 grand, your 100 grand, or whatever you put in, right? And so that part of it's kind of neat.
Right. Right. That makes sense. And one thing I like, from an advisor's perspective is just not something entirely uncorrelated with the market, but reducing market correlation. So a lot of
Yeah,
times our clients are looking for diversification, and that means finding assets that are not necessarily moving up and down directly with the market, so that we're more properly diversified. And then at the end of the day, there's maybe you can speak to this briefly of just the fact that we're getting a premium or a reward, you could call it, for the illiquidity that we're having for a period of time. So what's kind of the time frame we're looking at with this?
yeah, and just to back up a little bit to what you were saying is, I would say that for by and large, right, we're not this type of investment's not traded daily, so it's not moving up and down with the market. So it's uncorrelated to what the stock market does today. It's uncorrelated to what the bond market does today. And because we don't leverage the fund, it's also uncorrelated to the interest rate environment, right? Directly. Now, obviously, it can affect anything within the economy can affect commodity prices, so it can affect the performance of a fund. But by and large, it's uncorrelated, which is nice.
Sure.
And so, but yeah, it's an alternative asset, and like most alts that don't have that liquidity premium to them, you're looking to create some alpha, right?
Right.
With this, and because of the extra risk you're taking in terms of the lack of liquidity, right? Which this is definitely a non-liquid investment. So
Right.
yeah, I mean, over the course of the investment, we're looking for hopefully somewhere between a you know high teens, meaning 13, 14 to maybe as high as 20% annualized return before this fund's over, right? And so if we can deliver that, then we're definitely delivering some alpha over the what would be just an index fund.
Right. And I think sometimes people view investments in a vacuum where, um, and then we like to either put a tag of either that's a good or a bad investment, and look at maybe just the positive or negative side of it, like, oh, that's an illiquid investment for X number of years. Where in reality, if the advisor or if you're self-managing, if you're doing it the right way, we're just looking at it as piece of the pie. And obviously we have to have some liquidity elsewhere, which
Sure.
maybe now's a good point to pivot to, um, I guess this opportunity is limited to accredited investors.
Yeah.
So,
So our fund's a 506c offering, which means you do have to be accredited. You do have to
yeah,
verify that. So, um, yes, it is accredited standardization that you have to meet.
yeah, and I think that just means from the perspective of accredited investors, $1 million or more of investable assets, or I think it's 200,000 of
Yeah.
annual income or 300 joint. Uh,
Yes.
Obviously, that crowd is maybe going to have a little bit larger portfolio, so they're going to have some liquidity that they perhaps, they have an opportunity to, hey, I'm going to seek excess returns by putting this block illiquid, so to speak. So that's kind of the trade-off. I always think of investments as terms of like you have your growth, your safety, and liquidity, and often we can get two of the three, but we can't always have all three of those, or we might be
Right.
able to have little pieces of all three, but typically we're going to have to kind of prioritize those three. So, um, anything else you want to share on like the investment side of this before we jump into more of the tax aspect?
Yeah. I mean, well, I mean, that leads into that, right? I think that the oil and gas it is a unique investment because it has what I call tax alpha to it as well. So,
Yeah.
which we can jump into when you're ready. But yeah, I think that's makes it a little bit of a unique investment for sure.
I guess the one question I get asked sometimes, and in my head, where I go with any investment, even if it's just kind of a simple mutual fund or ETF, um, I always like to think through there's always the past history that you look at and you kind of think of best case scenarios, but I always like to prepare for worst case scenarios too. Um, in your head, I guess the question I would get is, where could this go wrong?
Sure. So for us, we're trying to limit that downside, right? So if you're asking me what's the downside, worst case scenario for us, then that would be, maybe it's just a return of capital, right? Now, the way we structure our funds, our participation is significantly higher after return of capital, so that would not be a good outcome for us. And what would drive that, really? The only thing that would really drive that are significantly lower commodity prices for an extended period of time. So that could drive it. The other part that could drive it is if just the performance of the assets that are in the fund, and in other words, the individual wells, there was a significant difference between what was projected versus what performed. Now, again, going into the tier 1 areas, that shouldn't happen. But again, can't guarantee anything. So, but I think in this type of investment, you're obviously commodity price, right? The gas and oil, because most of the wells that we invest into will have an oil stream and a gas stream. So there's two cash flows coming to it. So exposure to both commodity prices. So, you'd have to have a significant drop in both prices to have that really downside risk of even below return on capital. But, I would think a downside scenario for us is, again, we're trying to limit that to be worst case scenario of just a return of capital.
Right. Yeah, that's helpful. And I think you've maybe talked about where historically, I mean, in the recent past, was it maybe through COVID where prices have come down, but it's not impacting things to such a negative extent because it's not an extended period is really where things could go sideways. But that's often where, maybe other things are, we have larger challenges if that's the case too, probably.
Yeah. I mean, I think when you look at oil prices specifically, like the last 10 years, depending on the time frame you look, but the last 10 years in general was around $64 and change on the WTI. The last 5, really under the Biden administration, was just above 74. Currently, where we're trading, I think today we're down a few bucks because of the potential peace talks in Ukraine. So I think we're trading around 58 or 57. But I think historically, if you look at oil prices, it kind of trades in that $55 to $75 range bound. There will be things that can push it above that 75 or below that 55. But when you look at a chart on oil specifically, they don't stay there very long, meaning the recovery back above that is not significant. Now, natural gas can be different. Natural gas, and when I say lower natural gas prices, I really mean sub $3 an MCF. There are periods over the last decade, and even by itself, that you've had periods of 12 months or longer of sub $3 an MCF, which is difficult to make money on a retail basis from our perspective. So, but natural gas prices are pretty good right now, but that's because we're heading into the winter season, and so which you typically have a bump up, and colder weather is forecasted. At the end of the day, believe it or not, natural gas will trade on heating and cooling days, right? There's a projected amount of heating days, and then there's a projected amount of cooling days. And if the market ends up being higher or lower than that, it'll affect the prices, right? So it's a little bit different, kind of what drives natural gas versus what drives oil prices.
Right. All right, this looks like a good place to hit pause in our conversation for today, but we will release part 2 in just 1 week so that you have plenty of time to review this strategy if it's something worth considering before year end. So far, we've spent most of our time talking about the investment aspect of oil and gas. And when we come back, we're going to talk about the unique tax benefits and how we can directly reduce taxable income, as this is often what attracts so many people to the oil and gas space in the first place. So until then, you can check out all past episodes at integrityguidance.com. Just click on the podcast tab and you'll find everything that we've recorded there. God bless, and we will see you again next week.
Thank you for listening in and supporting this show. And if you have a moment, we'd love a 5-star review to help this podcast reach even more listeners. Also, this show thrives on feedback from its audience. So if you have any topics you'd like to hear covered or have anyone specific you'd like to see join the show, please email your recommendations to our address, hello@integrityguidance.com. That's hello@integrityguidance.com. We review every email that comes in, and we will do our best to include any recommendations you have for us. Thanks again, and be sure to follow our show so you don't miss an episode. This podcast is for entertainment and informational purposes only and is not intended as specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and owner of Integrity Wealth Management, a flat fee firm which serves pre-retirees and retirees in search of their own work optional lifestyle.